we'll be looking at the connection between climate risk and financial reporting. How has climate risk influenced financial reporting and the way forward? The content will be an introduction. We'll look at what is climate risk and why is climate risk relevant to finance, and the linkage between climate risk and financial reporting. After that, we'll look at the impact climate risk has on the statement of financial position, which includes our assets and liabilities. Then we'll look at the influence or the impact of climate risk on the statement of financial performance, which is also known as our profit and loss account, which includes our revenue and costs. Then we'll look at the ideas of disclosure and transparency in terms of climate risk disclosures. We'll look at the key reporting challenges and the evolving role of accountants and finance professionals in reporting climate risk. Then we'll take a look at real world relevance and connection. After that, we'll end with a conclusion. Introduction. Climate change is no longer just an environmental issue. It is a financial and reporting issue. Companies are increasingly expected to reflect climate risk in financial statements. Climate risk is not just about the future, it is already affecting today's financial reports. Climate risk, just like years back, didn't used to be a major risk associated with financial reporting. But in terms of the materiality, in terms of the influence and the impact it has on businesses, it is now a relevant cost and a relevant item that is material and should be disclosed in our financial reports. What is climate risk? Climate risk actually has two major components, which are known as the physical and transition risk. Some other school of thought includes the reputational risk. What is physical risk? Physical risks are climate risks that are often classified under physical risk, which can be divided into acute and chronic risk. So physical risks are the risks that are actually sort of physical to the environment, and it's more associated with the natural sciences as physics, and that involves the interaction between matter and the environment and matter and itself. So physical risk involves two major risks, which is the acute and chronic climate risk. What is the acute climate risk? Acute risks are risks that arise from sudden extreme weather events that occur unexpectedly and have immediate impact. So these are sort of short-term, unexpected climate events such as floods, hurricanes, heat waves, and wildfires, whereby chronic risks arise from long-term shifts in climate patterns that develop gradually over time. And examples could involve or include things like change in precipitation level, increase in temperature, rising sea levels, and water scarcity. What are the other risks that are associated with climate? We have transition risk. And what is the transition risk? Transition risk are risks that involves the transition into a net zero carbon economy or a renewable economy. And such risk involves risk like policy changes. Policy changes like carbon taxes can actually have an influence on the financial reporting. Legal implication. What are the legal implications? Legal implications like things like contingent liabilities or legal disputes can actually have an impact on the transition to a net zero economy. So things like market demand such like electronic vehicles could actually have an impact on the transition risk into the net zero economy. Then a third risk, which is the reputational risk, a risk that involves stakeholder expectations and ESG pressures, which can actually have an impact on financial reporting. Why climate risk matters to finance? It impacts cash flows and profitability. Climate risk will have a major impact on cash flows. And what impact does it have on the cash flow? It can actually have an impact on the operating, the investment, and the dividend decisions of our cash flows. It could affect our asset valuation. Climate risk will actually affect assets such as reserves, long-term assets that are actually sort of related to climate matters. It could influence our investment decisions. It could actually have an impact on institutional investors and how to allocate their resources in terms of investments. It could have an impact on the cost of capital. How does climate risk link to financial reporting? Climate risk affects our assets and liabilities, which are components of the statement of financial position. And it also has an impact on the statement of financial performance. And the components which it actually has an impact are the revenue and expenses, which are also known as our profit and loss accounts. It could actually have an impact on disclosures, which means our financial statements must reflect material risk, which means any risk that's been omitted or neglected would actually have an impact on the decisions of the users of those financial statements. Impact on assets. Climate risk will have an impact on various assets, such as impairment of assets. Examples, stranded assets. Stranded assets such as oil reserves would be affected by climate risk, because if there's a movement to a net zero economy, some assets will actually have to be stranded, such as oil reserves, because there will be no need for carbon intensive assets. Also, it will actually have an impact on the useful life of assets. Assets that actually have long useful life, such as the oil and gas industries, will actually have a reduction in the life cycle of these assets or these products and cause a reduction in the useful life of the assets. It could also have an impact on lower recoverable amounts. Example, oil assets losing value due to transition to renewable energy. Impact on liabilities. Climate risk will actually have an impact on liabilities, which is sort of influenced or associated with the International Accounting Standards 37, which is provision, contingent assets and contingent liabilities. So it could actually have an impact on provisions for environmental obligation, such as cleaning costs, oil spillages, and also it could actually have an impact on contingent liabilities, such as legal liabilities, which might emanate from things like fines, penalties from legal disputes. Also, it could have an impact on decommissioning costs. Example, cleanup costs for environmental damage due to climate or carbon intensive assets. So, impact on revenue and costs. Climate risk will actually have a major impact on the statement of financial performance, also known as the profit and loss statement, or also known as the income statement. It could lead to increased operating costs, such as compliance costs for carbon neutral economy, energy transition. It could also affect changes in demand for products, whereby people demand for carbon less intensive products, such as electronic vehicles. It could have an impact on supply chain disruptions too. Disclosures and transparency. Climate risk needs to be disclosed. There needs to be enhanced disclosures. There needs to be some framework voluntary disclosures, and also sort of mandatory disclosures for climate risk to be embedded in our financial reporting statements. Also, assumptions used in estimates must reflect climate risk. Our assumptions must embed climate risk, just like other climate or other accounting assumptions. It should be integrated with narrative reporting, example, sustainability reporting. The IFRS 2, which is more of a sustainability reporting, the IFRS 2 should integrate narrative reporting, where we are able to declare climate risk as a major risk that affects our businesses. Key reporting challenges. One of the major key reporting challenges of climate risk is uncertainty in measurement. We do not have a standard of measuring climate risk. There are different scopes, whether it's a scope 1, scope 2, or scope 3, but there is no standard unit in measuring our climate risk, which leads us to the lack of standardized data. Our data are not standardized in terms of declaring climate risk. Also, there's estimation complexity. Estimating climate risk is sort of complex. It involves a lot of spurious variables which might actually not be standardized. And also, there is management bias risk. Management might be involved in things like greenwashing, which might be a key reporting challenge in terms of climate risk, rather than reporting in terms showing a true and fair view of how climate risk affects our businesses. What are the role of accountants and finance professionals in disclosing climate risk? They need to integrate climate risk into financial reporting. Accountant needs to integrate climate risk into our financial statements or reporting because they are quite relevant or material risk of our businesses. They should ensure transparency and accuracy. Climate risk should be transparent and accurate enough in order to actually embed this risk in our reporting. They should support strategic decision making. There, our risk committee or our risk management should embed climate risk in our decision in order to make the business sort of a going concern because of the relevance of climate risk to our businesses. Climate risk should align reporting with global standards. So our climate risk reporting by accountants should be aligned with the global standards such as the TCFD, which is the Task Force on Climate-Related Financial Disclosures, which has been moved into the International Financial Reporting Standards S2, which is also known as the Climate Reporting, or also maybe the Global Reporting Initiative or other global standards, or if need be, voluntary standards. So what are the real-world relevance of climate risk? Investors now consider ESG factors. There are some principles for responsible investment whereby institutional investments now take climate risk into consideration before investing. Regulators increasing disclosure requirements. Regulators now have stringent disclosure requirements in terms of climate risk, which makes it sort of relevant for investors. Companies ignoring climate risk face financial misstatement risk. In conclusion, climate risk is financially material. That means it's significant, and its omission or misstatement can actually have an influence on the users of the financial statement. It must be embedded in financial reporting. That means we need to take climate risk into consideration in our financial reporting. The future of accounting is equal to sustainability plus finance integration. Financial reporting that ignores climate risk is incomplete and potentially misleading.